Can't live with them, can't live without them. I'm obviously talking about banks. Now, there can be no denying it's been a fascinating full-year results season for the banking sector, and this seems like a good time to take stock, especially as we've seen Lloyds reinitiate dividend payments, Standard Chartered announce a change in both chairman and chief executive, and earnings numbers actually generally disappoint. Hello, I'm Russ Mould, RBS Investment Director, and this is the latest edition of Breaking the Mould, our regular look at the financial markets. Now, at around 15% of the FTSE 100's market capitalisation, the banks are hard to ignore whether you love them or loathe them from an investment perspective. And given their substantial weighting in the benchmark index, they've quite a big say on where the UK market's going to go, not least because they also represent between 15 and 20% of the forecast aggregate profits and dividends expected by analysts for this year. Now, looking back on the full year results season, let's first of all emphasise the positive and look at the good news. First, the big banks continue to cut costs, sell assets and sweat their balance sheets as they prepared for the regulatory requirements placed upon them when it comes to their financial strength. Common Equity Tier 1 or CET ratios continue to improve at Lloyds, Barclays, HSBC and RBS, with only Standard Chartered of the Big Five failing to deliver here. The chart behind me shows the CET ratio as bars on the left and the change last year in percentage points as the line on the right, and as you can see, generally a favourable trend. Second, Lloyds began paying their dividends again with a proposed 0.75 pence per share final payout. Now, this is a big issue for income hunters in particular, and may be a sign management really believes the firm is finally turning the corner. The third piece of good news was that Barclays and RBS are still slimming down their investment banks. Now, earnings here are very cyclical, highly unpredictable, and de-emphasising them should lower risk and improve the quality of those banks' earnings. Now, it wasn't all good news. On the downside, provisions for scandals such as payment protection insurance and malpractice in the currency markets are still coming through. HSBC suffered some unwelcome publicity regarding both its chief executives and some of its customers' personal tax affairs, particularly relating to its Swiss private bank. And ultimately, and most importantly, earnings numbers were a bit disappointing overall. Yes, the Big Five racked up pre-tax earnings of £29.3 billion between them, way up from the £12 billion seen in 2013, but analysts had been expecting some 36 billion quid back in December, so they undershot that by quite a way. That in turn has led to a forecast cut of around 7% in total for 2015 estimates, and based on this year's consensus pre-tax figure estimate of around 35 billion, the banks are still expected to earn less than they did back in 2007. Now, a fascinating research note from French investment bank Exane BNP Paribas argues banks are all about economic recovery on one side, regulatory cost pressures on the other, and to what degree they offset. Now, analysts do expect profits to rise this year, but given how complicated those profit calculations are, BNP Exane argues the market really looks to be favouring those banks which are improving their capital strength and equity base, or book value, and growing their dividends. Now, the equity growth may explain why RBS was the best performer of the Big Five over the past 12 months. The bars behind me show the percentage change in the Big Five share prices. Now, RBS may be up 13% over a year, but the banks actually as a group are doing pretty poorly. The sector's down around 1% in 2015 against a FTSE All-Share that's up 5%. So the market is clearly looking for reassurance there are no more scandals on the way, the UK economy stays on the up, and costs are still under control. So that's it for this week, and I look forward to seeing you next time.